After 50, and especially in retirement, the market isn't the only threat to our wealth. It's taxes too. Because while market declines are very visible, tax inefficiencies are often hidden and silent. And over time, they can cost us thousands without us even realizing it. Ugh. Welcome to the Wise Lane, where we focus on money, mindset, and modern living for the over 50 crowd. Yes, here's a round of applause for the over 50s. Yeah, how about a golf clap too? Sure, golf clap. I'm Scott Mullet, and this is the sixth and final episode for now of our Investing Over the Age of 50 series. It's entailed episode 17 through 22 of the Wise Lane. We've talked about getting an investing mindset shift, common mistakes made, all types of risk, the benefits of simple portfolios, and also staying calm during market crashes. Now we're finishing up with one of the certainties in life, according to Benjamin Franklin, and that's taxes. Actually, the attributed Ben Franklin quote is, "Nothing is certain except for death and taxes."
Check out the big brain on Brad.
Now, we chose to discuss taxes because small little tax decisions repeated over time can have a meaningful impact on our financial life. And why do taxes matter more after retirement? Well, during our working years, taxes are mostly handled for us, especially if we worked regular W 2 jobs, right? Because the income comes in, taxes are withheld by our employers. Simple. But in retirement, suddenly we are now in control. Oh no. There's no more W 2s, but boy, we can get a lot of K1s, K3s, 1099A, B, INT, NEC, DIV, more. Plus, there's withdrawal timing, asset sales timing, investment account selection. That flexibility, it can create opportunity, but it also adds complexity. So let's go through some of the tax mistakes to avoid. Mistake number one is withdrawing without a strategy. Now, many retirees take money from whichever account feels easiest. Oh, I'm going to grab a little from here. I'm going to grab a little from there. A little from column A, a little from column B.
A little from column A, a little from column B.
But different accounts are taxed differently. Some are taxed as income. Some are taxed at lower tax rates. Some grow tax deferred. Some have no tax at all because you already paid the taxes. Now, without a plan, you may unintentionally push yourself into a higher tax brackets depending on how and when you withdraw. This higher tax bracket may not hit because you earned more, but because you withdrew inefficiently. Oh, so sad. Mistake number two is ignoring future taxes. Some investors focus only on minimizing taxes today. But what matters just as much is, what will taxes look like later in the future?
Next Saturday night, we're sending you back to the future.
Large deferred accounts can create bigger required withdrawals in the future. The acronym RMD stands for Required Minimum Distributions, which can increase our taxes at a time when our flexibility might be lower. The goal isn't just minimizing taxes this year, it's smoothing our tax burden over time. So, mistake number three is overlooking simple adjustments. Because many tax improvements, they don't require complex strategies. They just require awareness, timing our withdrawals differently, spreading income across years, and if possible, realizing gains across years. And yes, tax codes do change, but knowing how they operate is key. For example, capital gains at the US federal level, as of the date of this video, are taxed at a higher rate at one income level than they are at another income level. So the key is to be intentional about when and how much money is being withdrawn or realized in sales. Small adjustments repeated over time can make a meaningful difference. Yeah. So, mistake number 4 is forgetting the big picture because taxes don't exist in isolation. They interact with Social Security, healthcare costs, income levels. Sometimes reducing taxes in one area can increase taxes in another. That's why decisions should be viewed holistically, not in isolation. The ultimate goal isn't to eliminate taxes because, frankly, that's just not realistic on a legal level. If Ben Franklin said so, then that's going to be the case. There are death and there are taxes. I think our goal should focus on being thoughtful. We need to understand how our decisions affect what we keep. Using good accountants, tax advisors, or tax advising software can be very helpful in our tax planning. Because after 50, the difference between a good plan and a great plan is all about what we keep, not just what we earn. Okay? Okay. Let's wrap up and tie with a bow. Taxes aren't fun. They're not exciting, and they're usually a pain in the arse. But they are always an important part of our financial plan. And over time, small inefficiencies can add up. A little awareness now can make a meaningful difference later in the future. And with that, we've wrapped up our six-part investing series. As the investing topic is definitely near and dear to me, it's how I made my living then, it's how I make my living now. It will remain a focus of future Wise Lane episodes. You're going to hear this topic brought up more. But in the meantime, boy, there's a lot of other fun stuff for us to get to as well, like what are the top songs being streamed by the 50s and over crowd? I mean, inquiring minds want to know this. Therefore, you should check out our next episode for more on that subject. I'm Scott Mullet. Thanks for watching.